Welcome, everyone. You are in a joint webinar organized by Franklin Templeton and futusg Singapore, the Moomoo training app. And now, today, we're on the second day of a series of webinars that we have in store for you. I'm Oliviahiggins, and we're about to discover today some key topics that are discussed in our communities. So get your notes ready as you're about to be a part of the discussion. Now, yesterday, we had an open discussion about investment implications of the Russian-Ukraine conflict. And today we will delve into an outlook for global bonds. So thank you so much for joining us, but do stay for the Q&A towards the end where we answer some of our favorite questions. Joining me today, we've got two experts, Eugene Lau, Vice President of Financial Institutions, and Johnathan Lim, who is the Regional Relationship Manager of Asia. Hi, Eugene. Hi, Johnathan.
Good evening.
Hi. Thank you for joining us today. Maybe, gentlemen, tell me more about yourselves.
Go ahead, Eugene.
Okay. Hi. Good evening, everybody. I'm Eugene. I'm the Vice President of Financial Institutions here at Franklin Templeton. So my role is to develop the business relationships between Franklin Templeton and intermediaries such as futusg, and also to articulate our house views and our products so that you can find a suitable investment solution for your portfolio.
Hi, I'm Johnathan. I work for Brandywine Global. We are a specialist investment manager under Franklin Templeton. I've been with the firm for 4 years now. I'm a regional relationship manager, so I look after Brandywine's institutional clients in the region, so Asia, including Japan, and I'm responsible for making sure they're happy and growing the business as well. Today, lastly, I'm here to share some pointers on the outlook about the fixed income market.
Excellent. So Eugene, perhaps you can tell me a bit more about Franklin Templeton's role for today and how the viewers watching might be able to benefit from the analysis.
Thank you, Olivia. Glad you asked. Well, I'm just going to start off with a little quote from one of our former executive chairman, Mark Mobius. I mean, it's a name that's synonymous in the industry. And Mark Mobius once mentioned that the secret to global investing is gaining an insight into the hopes and desires of the people who live and work in the countries you invest in. So very good evening again. I'm Eugene and I represent Franklin Templeton. And this is the second of our 3-part series organized by our esteemed partners, futusg. But first, who are we at Franklin Templeton? Now, Franklin Templeton is one of the world's largest independent investment managers with over $1.5 trillion in assets. Now, we bring together an unmatched collection of independent specialist investment managers to provide clients with deep expertise and boutique specialization across asset classes, investment styles, and geographies. Now, from large institutions to individual investors, each of our clients wants the same thing, and that is to achieve their financial goals. And for more than 70 years, we have helped them do exactly that. Everything we do at Franklin Templeton is focused on delivering our clients better outcomes. Now, we are present in 34 different countries with over 70 offices worldwide. And we aim to offer the best of both worlds, global strength and boutique specialization. To be nimble where it matters, unparalleled in our ability to customize and guided by long-term value creation. Now, to share with you a little bit of corporate history. Now, about 2 years ago, Franklin Templeton acquired another asset manager called Lake Mason. And along with that acquisition came her affiliate boutique fund managers. And with this acquisition, Franklin Templeton now has at her disposal capabilities from fund managers such as Brandywine, Clarion Partners, Clearbridge Investments, Martin Currie, Royce, and Western Asset. And we now offer a holistic range of investment strategies across 19 subsidiaries, or what we call specialist investment managers. And tonight, we are pleased to have one of them, Brandywine Global, to give us an in-depth perspective on the global fixed income market and how we should position our bond portfolio for 2022. Over to you, Johnathan.
Thank you, Gene. And I don't know if it'd be helpful since like Brandywine Global is not the name that Franklin Templeton is. If we could just kick off with a quick introduction of the firm. So Brandywine Global has nothing to do with alcohol. We don't sell brandy nor wine. We are a boutique investment manager. We're based in Philadelphia in the United States, and that's largely where the name comes from. There's a river that flows through Delaware and Philadelphia and Pennsylvania, called Brandywine. So if you go there, you see a lot of firms with that same name. As a manager, we are very focused on value. Value really is one of our key tenets as a global investment manager. We are at our heart a manager that wants to seek investments that we find valuation anomalies. We want to buy things cheap. We want to buy things that are undervalued. And we don't want to own things that are overvalued. I mean, it's easier said than done, and it sounds simplistic, but at its core, that's what value management is. We are also a top-down macro manager. What that means really is when we look at our portfolios, we decide how we are positioned really from that global macro perspective. We look at the world, we understand what the information is telling us, and that's how we're going to be implementing positions in our portfolios. And that's really why I'm here tonight, just to share some insights from an outlook perspective on the fixed income markets. Yeah.
Okay, thank you, Gene, and thank you, Johnathan, for that intro. So to the core question, Johnathan, why should investors be interested about fixed income right now?
Yeah, that's the perennial question, isn't it? As an asset class, like fixed income really has fallen out of favor of late, whether it's because of inflation worries, rate hike fears, etc. And it's completely understandable. But I think the reaction of the solution really shouldn't be for investors' portfolios to be completely divested of fixed income. I think fixed income still deserves an allocation within your larger asset allocation of your portfolio as part of more long-term strategic positioning. Now, it's really up to you whether you want to dial up or dial down the risk level, whether it's going to be 60-40 in favor of equities or 85-15. And that really is largely dependent on your risk appetite, your age, etc. Nonetheless, I would still argue that fixed income deserves a spot in your portfolio, and it really is because it functions as that hedge against equity volatility. And I'm going to bring up some slides now, just to sort of like maybe bring this point across a bit better. I mean, it's a controversial topic at the top, right? Our bonds did, and we've chosen like the market where you see rates at an all-time low for like the past 10 or so years, 20 years even. Japan has been that market. We've seen interest rates in Japan at zero or below zero for the longest time. So what's the value that we see in Japan? Do we still need to allocate to fixed income even if you're going to be yielding it close to zero? What's the point, right? And the argument we're trying to make here really is on this page here. In this chart, it's a bit complicated, but the gray bars here are going to be the Japanese equity market drawdowns. And the bars at the top are going to be the performance for your various Japanese government bond indices. And what you see really is that during major Japanese equity market drawdown events, allocating the bonds really serves as a hedge against equity volatility, serves as a tactical allocation that you can make to prevent your overall portfolio from having and experiencing the drawdowns that you usually get with equity volatility. And this chart here, assumes that there's no active duration management. All you're doing is allocating to the index. And even then, when you're not making an active choice in the bonds or the part of the yield curve to allocate to, you still see a very positive influence at having allocated to bonds in your portfolio. So bond investors really need to make a key trade-off here. Whether you want core bonds, which are inverse to lowly correlated to equities, or you want more satellite type exposures, we tend to have higher correlation to equities, like high yield, like emerging markets. And the caveat here really is because fixed income is not a monolith, right? There are many different sectors within it, from government bonds to corp IG, investment grade, and high yield, structured credit, emerging markets. You're looking at a global fixed income market that's almost twice the size of the equity market. And so how you want to be allocated within the fixed income universe really is, with an active manager that understands the fixed income market, with a manager that can intelligently asset allocate across the different sectors, depending on the macro environment, depending on where the macro is telling you. So you really want a strategy that is flexible enough that can short overvalued markets, especially in an environment that we're in right now where everything looks like selling off, especially on the fixed income front. Because without the ability to short, you really use a tool that you can use for risk management to defend your portfolio. But more than that, it's also about finding value and finding opportunities within the various fixed income sectors and being able to bring our investors that kind of returns that they're seeking from a bond portfolio. Bonds really acting like bonds as a foil against sort of equity volatility. Yeah.
Well, thank you for that, Johnathan. And what are your views then on inflation and the Federal Reserve's interest rate policy?
Yeah, it's another timely topic. Tonight's the FOMC decision, right? The Fed's going to make a decision tonight. And we are watching it closely. We're with the market on this. 25 bips is probably where we'll end up. What we're really looking for and listening out for is what Powell will say when it comes to how the Fed is going to react for the rest of the year. Are they going to proceed with more tightening, going to proceed with more QT? What is their rate expectations for the rest of the year? Right. So that's the news that we're listening out for. Last week, you had the ECB surprise the market by indicating a more hawkish stance than anticipated. They chose not to look past the war in Ukraine and the increase in headline inflation and go ahead with easing, go ahead with potential rate hikes at the end of the year. So when you think about inflation, you think about interest rate policy, it's very important to also think about the growth outlook, because that's exactly what the Fed is trying to do. One of the biggest questions facing the Fed now is how policymakers are going to both get a grip on inflation without crimping economic growth, right? So what's the growth outlook? I think coming into this year, we thought that growth would moderate, but it would not sort of slow down too much that we are in a negative growth environment. It would still be positive and higher than trend. But right now, and I think for most of what we're going to be speaking about today, we're going to have this sort of like two phases of the world, right? There's pre-Ukraine war and there's post-Ukraine war from a outlook perspective. Pre-Ukraine war is largely that. Post-Ukraine war, we're starting to see inflationary pressures really come in, whether it's from the increase in energy and food prices, whether it's from other more extraneous developments that comes out from the Ukraine war. So inflation in Europe is definitely going to pick up. Inflation in the US is definitely going to pick up. And we think that we might be looking at a stagflation type scenario, especially if central banks hike and become too aggressive, right? Then you're going to get a scenario where inflation sort of still stays hot, but growth is crimped. And that's not where we want to be, right? Anecdotally, even, if you look at Ukraine has an important metal that goes into automobile manufacture. And, in Singapore, if you drive a Continental car, not speaking from experience, you'll find that spare parts are getting harder to come by. Your mechanic's going to tell you that if you're going to do servicing today, you need to wait, or certain spare parts are not going to come by, and you'll feel inflation really come to the home front. You'll feel it where we are standing right now. So I think that's a broad view in inflation. It's a bit rambly, but.
What if we contextualize it a bit to just Asia Pacific, and even touching on yesterday, we covered a bit on developing economies, and I think we would love to know your views on this with regards to inflation and interest rate policy.
Yeah, so that's a good question. Developing economies, again, it's going to be two stories, right? Pre-Ukraine war, where we saw the emerging markets was they had started on their rate hiking cycle a lot earlier than the developed markets. The emerging markets were keeping inflation under control, whether it's Brazil, Mexico, even Poland and Hungary. The central banks there were ahead of the curve. They were hiking. And we really liked that from central banks, right? So we were thinking that 2022 was going to be a year for emerging markets, right? Once you see inflation in these countries start to come down, the bonds are going to rally. And so that's where we were looking to allocate. Now, after the Ukrainian war, energy and food prices have increased, and we did like some sensitivity analysis and found that emerging markets tend to be more highly impacted by increases in energy and food prices than developed market economies. And if you think about it, it makes sense because the CPI basket in these emerging economies will have a higher weight to food prices, given where they are in the development cycle. And so what you see is that in the emerging economies, there have been more expectations being priced in for rate hikes, right? So they are not as late in the cycle anymore. They're not going to be turning around and starting to perhaps ease their economies a bit, right? Mm-hmm. So now they really want to keep inflation under control. So emerging markets, from a bond perspective, they might not present the same opportunity and same value as before. Where we're seeing opportunity in emerging markets really is from a currency standpoint, right? And we are allocated to emerging market currencies that are commodity exporters, right? So energy has gone up, commodities have gone up. These commodity exporters will stand to benefit. You'll see the current account surpluses start to improve, the terms of trade start to improve, and these are all going to be supportive for the currencies as a whole.
Okay, thank you, Johnathan. So in more recent news, how are you protecting your portfolio from the fallout?
Yeah, the war in Ukraine has been a tough one to call. And it brings the point back to what we were discussing earlier about bonds really acting like bonds, where we want to protect the downside, right? We don't want to necessarily reach for income, reach for yield at the expense of volatility, at the expense of higher equity sensitivity, right? So downside protection is really what you're looking for. And what we did in our portfolios really was we increased safe haven duration via US Treasuries, via German bonds, and we did largely through the use of bond futures. Because it provides you liquidity in the liquidity crunch environment. You can put on positions very quickly. We also held more dollars in the portfolio. USD is a safe haven currency. That's where you want to be positioned. Because of the war, we've seen the USD rally against a basket of other currencies. And we also continue to be positioned about 15% of the portfolio that we're talking about in short-dated US Treasury bonds, floating rate notes. These sort of serve as a cash proxy. We want to keep powder dry. We want to be ready to deploy once we see opportunities present themselves. And volatility in the market always presents opportunities. So that's really how we're looking at protecting the portfolio from the downside.
So you mentioned we touched on a few economies and markets, but I think a hot topic would be China as well right now, being a big driver. So I think my next question is there an opportunity in China right now and more broadly with the emerging markets?
Yeah, China again, it's a story of two halves, right? China has COVID has made a comeback in China, and they are somewhat struggling to keep the latest wave under control, especially in Hong Kong. They've got lockdowns in multiple regions. The COVID zero policy that they're pursuing is going to be deflationary in nature. It's going to slow down growth in China. You saw the Hang Seng Index sell off yesterday. There's been a slight rebound today, but still down overall year to date. And then you have potential sanction risks if China were to end up siding with Russia, providing them with military equipment. So we have actually been selling down our Chinese government bond position. That's largely because of where we see China in the overall easing cycle. And I'm just going to flick very quickly now to this slide over here. So where we are really is at the bottom here in 2022, right? So we've had, the Chinese credit impulse drop off. So they tightened conditions. They didn't let credit be so easy. And so that's why, the economy has slowed a bit. We think there's going to be a turn. So the latest numbers, of course, is another drop here. But we think overall trend is going to hit higher. And that's largely because the government, the authorities need to come in with more stimulus, whether it's monetary or fiscal. They need their economy to bounce back. Given, Xi Jinping's 5.5% growth rate for this year, they're going to need to do more if they want to see the Chinese growth rate hit that amidst, Russia, amidst COVID. So we think that we're going to wait and see with China. With the easing cycle, you're going to see perhaps rates drop, but what that will end up doing also is lead you into a tightening cycle, and that's sort of not where you want to be holding bonds necessarily. If you look at credit and corporates within China, the property sector, which was the headline topic of the third quarter last year, still remains very distressed. We saw Evergrande start to falter first, but it seems like that contagion has really spread through the entire property sector in China. Even investment grade issuers that had otherwise shown no signs of credit trouble have suddenly taken a turn for the worse right now. So the property sector, not where we want to be positioned at the moment. We think there's opportunity, but not just yet. And from a regulatory standpoint, what else have they been doing besides the property sector? The tech sector has come under fire. Chinese tech sector as well. So again, we do own some positions there, but it's not something that we are necessarily actively looking at from an opportunity perspective. We think it might be early in the game. Give it, 9 months, a year, perhaps the opportunity will be clearer. It will present itself better. The other question about emerging markets, I touched upon it a bit earlier on the duration and the bond side. The opportunity, we're not really seeing it there at the moment. We're really seeing it within the currency space. And it's, top-down global macro managers. Currency is going to be one of the alpha levers that we can pull in our portfolios to generate returns for our investors.
And what about, how the Chinese are actually easing their measures, for example, with regulation? How does that play a part in your analysis?
Yeah, so the easing Chinese regulations will help the economy to sort of have a soft landing. But we think that the measures that have been rolled out so far have been on the light side. The authorities need to do more in order to sort of really cushion that soft landing and bring it back up in the uptrend again. So there's no immediate opportunity right now. We don't think it's necessarily bottomed out. And we're sort of willing to look past that a bit, wait for the opportunity to really present itself, see that momentum of the upswing before we get in and allocate to China as a position portfolio. Yeah.
And what about us in Singapore? What is Singapore's position with all this?
Ooh, that sounds like a political question. What is Singapore's position with all this?
At least our positioning from here. Yeah. Because I think a lot of the investors, or at least the audience watching, they are quite interested. What does that mean for us here in Singapore?
Right. I think when we look at investing from Singapore as a Singaporean investor, the opportunity set in Singapore tends to be a bit small. So we do need to look a bit broader, perhaps like at the region, perhaps globally, right? And that's how we look at it as well, right? The investment opportunity set has to be global, so you don't sort of get yourself caught in a situation where you have confirmation bias. You're only selecting from the investment opportunity set that you have directly in front of you. Now, if you look at the region, from an inflation perspective, the Asian countries tend to have better inflation compared to your Latin American countries, largely because we've stayed under lockdown for a longer time. We haven't really had the bounce back in growth. So inflation is largely under control. That's it, right? Because we're still in lockdown, because we're still like sort of going through the pandemic, growth is sort of slowing to moderating a bit, right? If you look at an economy like Thailand, where tourism makes up a big part of their GDP, not having China open up, having China in a COVID-0 sort of situation is going to impact its ability to grow, right? Because you're not going to have Chinese tourists coming down and spending money. So as a region, Southeast Asia, we think that perhaps there are some pockets of opportunities. We like Indonesia, we like Malaysia, for example. Singapore is not really on our radar at the moment, but idiosyncratic sort of select countries are where we're going to be positioned within Southeast Asia.
Mm.
Yeah.
Thank you for that. I think the audience really benefited from the answer because we are getting quite a lot of questions coming in, but we'll save that for after. But if you have any more questions, do keep writing and keep asking and be a part of the discussion. But before we get to that, I do have one last question for Johnathan, and that is the idea of opportunities, right? You mentioned that a lot through our discussion. So where are you seeing the opportunities and the risks in the macro environment right now?
Yeah, I'm gonna like flip that on its head a bit and talk more about risks, like given where we are. Right now, we're really maintaining more of a defensive tilt to the portfolio. Alpha opportunities are few and far between, and a lot of it is contingent on how the war pans out. So we're definitely watching that. With the war, we think that it will likely end in negotiations. That's our base case. We think that once the Russians get to Kyiv, it will force the hand of both parties. We will see Putin and Zelensky get at a table. They will hash it out, and hopefully, we see an end to this war. But that's really how we think. The macro situation that we really need to pay attention to. But right now, before that happens, we're really maintaining a defensive tilt to the portfolio. I described it earlier. We've got safe haven in the portfolio. We've got dollars, and we want to keep powder dry. We want to keep cash in short-dated floating rate US treasuries. When opportunities present themselves, we'll deploy them. The opportunities that are in the portfolio at the moment within like corporate credit, we want to be positioned really in companies with pricing power in this environment, where they can sort of still maintain their earnings, right, despite whatever's going on. We want to be positioned at the front end of the curve. Intuitively, you don't want to be exposed to interest rate risk when duration moves. You don't want to see your portfolio sell, right? We like lower quality investment grade issuers. We also like higher quality, high yield issuers. What that means is we're going to be positioned really at the middle band of the spectrum between BBB, BB. We think that's where we see the most value. Higher quality IG issuers, you're going to get a lot of interest rate risk with them. They're going to be very interest rate sensitive. We don't want to be positioned there. Lower quality, high yield issuers, we're not sure where growth will pan out at the moment. So these might come under a lot of fire as maybe growth peters out, growth moderates. High yield is really starting to look attractive from a valuation standpoint as your option adjusted spreads near about 400 bips. We're seeing an environment with very low default rates. We're seeing an environment with strong corporate fundamentals, improving earning projections. We think there's a case to be allocated to high yield. We think high yield is looking attractive, largely because we need to view the pandemic and everything that's surrounded it really as an externality, right? It's not an economic-driven recession. It's not a financial recession. It is like it's a disaster, right? And the bounce back you've seen from that really has reflected that. So, talking about all these opportunities, we are always mindful of the macro risks that still remain. And the fund strategy that you eventually allocate to within fixed income needs to be flexible. It needs to be able to not only go long, because long positions are where you see opportunity. It needs to be able to hedge those risks, right? So you want that sort of more absolute return, less benchmark driven type of framework. Have the short position so you can hedge against like risks in the market. A flexible fund that will be able to time the market in such a way that you can protect on the downside and really deliver on the upside once the market soon comes back. If you think about getting back to 100 from 90, right? It looks very different than if you're at 95, right? And that's why we emphasize downside protection and capital preservation so much. Because from 90 to get back to 100, you're looking at easily more than 10% of returns. 95 to 100, a lot smaller. So if you can minimize the losses that you make in the long run, you actually make more for your investors that way.
Excellent, Johnathan. And I think a lot of people are quite, they're excited and they're actually writing in a lot of questions. So we will save that for the end. But before I go into a short demo for our audience, do you have any last thoughts for our discussion today?
Yeah, actually, if you don't mind, the fund and the portfolio that I've been speaking about like this whole time really is the Global Income Optimizer Fund, and I think you'll find it on the Moomoo platform. Right, so the full name is the Link Mason Brandywine Global Income Optimizer Fund. I apologize for how long it is, but Income Optimizer is just a quick way to remember it. And why we think like this fund really is such a compelling proposition for investors right now. We live in a low rate world, right? We live in a world where US Fed funds rate are close or at zero. From a real perspective, these are all below zero, right? Whether it's Germany or Japan or the US. And how are you going to generate returns in such a low rate? Well, we think that if you have a fixed income solution that is absolute return, it is return seeking, yet sort of like maintaining the defensive characteristics of core like bond exposures, that's Income Optimizer for you. Income Optimizer has a dual objective of seeking to generate an attractive income while still sort of preserving the capital for our investors. And when we take a multi-sector approach, I spoke earlier about the bond market not being a monolith. When you take that approach to allocating only to sectors that you see value in, and rotating intelligently from, whether it's safe haven government bonds or more risk-taking corporate high yield at the appropriate times in the cycle, that's how you get more consistent outcomes. There's a saying, you can't eat relative returns. You can beat your benchmark, but if overall you're still negative, you're not earning any money. So this strategy right here, this fund, takes a more absolute return approach to investing. And of course, the last point down here, strong downside management. I've said it many times. We think that this fund really encapsulates that. The largest drawdown for the fund was actually minus 5%, which was in March 2020. And that's impressive if you ask me, if you compare it to our peers who were down like minus 10, minus 11% during the same period. And we think, again, lose less money so you can make more money in the longer term. And just to like toot our horn a bit, these are some like performance metrics of the strategy, not the fund, but the underlying strategy. You can see that not just from a returns perspective, we stand at the top of our peer universe. From a risk-adjusted perspective, whether you're looking at Sharpe ratios or Sortino ratios. Sortino ratios basically is a how do you call it? It's a better Sharpe ratio because you don't want downside volatility, but you don't mind upside volatility, right? It's because you want to make money. And Sortino ratio sort of strips out the upside volatility and only shows you how much downside volatility you're taking. And the fact that both Sharpes and Sortinos are at the top of our peer range goes to show that we use our risk budget well. We generate returns of the amount of risk that we take, and we tend to have more upside potential overall. And of course, the last point here is going to be max drawdown again. We think that's a real key selling point for this fund. Yeah, so that's my little spiel.
Excellent, Johnathan. Thank you so much for your comprehensive insights. And I'm sure the audience, they are waiting to get their questions answered at the end. But we'll come back to you. Now, if you have any more questions for Johnathan, do leave a comment in the Moomoo app and we'll get to it at the end of the webinar. Keep taking notes because we're here to help you and give you the educational tools to make better investment decisions. Now, you've heard the analysis, but how do you exactly get access to the Franklin Templeton's funds? Now, if you have your Moomoo app with you, I'm going to quickly show you how to navigate funds in app. So when you first enter the app, it will look just like this. Here we go. It will look just like this. You look for MoneyPlus and you click on Fund Houses on the top and you should be able to see Franklin. Click on the icon and you'll get the full listings of the funds run by Franklin Templeton. Now over here, you'll see the full comprehensive data on what you'll need to know about the fund house, what it entails. You've got the fact sheet, the performance, subscription details. And so for the purpose of today, we will definitely use Franklin's profile. And if you look at the general profile, you've got the NAV, the net asset value, so you can calculate the change in price. And then you can see just the overall general features. However, if you do want to go into a bit more detail, just click on position details to find out more. And I personally like this because you can assess the weight of each instrument, the performance, the type of region and sectors they're involved in. And for subscription, I think it's a great complementary tool to help you gain a better understanding of their strategy and their concept. And my personal favorite, the news feature, is really an excellent tool because it helps you to stay on top of everything related to the fund house. You've got the entire composition of all the media channels as a summary. And so click each article for further details. Now, I understand that sometimes it's a little overwhelming. So if you want to take a more macro approach, you can go into the entire summary of this fund under summary, and it's essentially the basics: the country, the fund documents, and here I think this one is particularly important, the fund managers. And if there's one key takeaway you take from this, it's this: in determining a fund house to invest in, you want to measure performance. You want to find someone as well that you can trust to manage your portfolio. So I think this is great because it's an active management portfolio feed, and you can assess credibility and details of each fund manager, so that you know about the right person you can help, who can help you with your money. Now, if you have any questions about this feature, remember that you can always leave a message for our team and we'll get back to you. So yeah, right now, I hope you really enjoyed that short demo, but of course, email us if there is any other question. All right, I would like to now invite Johnathan back into the room. Hi, Johnathan. Hi. So to the most exciting part of the webinar, we've got some questions for you. The first question, a viewer would like to know, so what is the impact of liquidity crunch on bond investment?
Yeah, so liquidity in the bond market. Now, the bond market is way larger than the equity market. And I think you need to look at sort of segments in the bond market where you have liquidity crunches. Now, the government bond market, that's, nothing needs to be said that it's liquid. You can buy, sell stuff like at a pinch, at small, at low trading fees, right? Corporate IG generally is going to trade well as well. High yield is sort of where you get into more perhaps illiquid environments, but that's not where this fund is going to be allocated to. We tend to be allocated largely to very liquid markets. Liquidity is a measure that we use when we decide on where we're allocated to. We want to be able to liquidate a position like within 3 days, right? And that's largely how we size our positions as well. You will take an illiquidity discount into consideration. And if that particular name or the particular security tends to be a bit more illiquid, we will size it down. So it will hold a smaller weight in the portfolio. I hope that answers the question.
Great. Second question, is it better to invest in stocks or bonds in the current environment?
Yeah, good question. I think Stephen covered that yesterday, right? I'm not sure, but I spoke with him about his views, and from an overall Franklin Templeton perspective, from an asset allocation perspective, I think we are slightly tilted more towards the equities, just slightly. I would agree with that from a asset allocation perspective, but as I mentioned earlier, I think it's not a black or white decision, right? It's a continuum of grays. So it's not just all bonds, all stocks at any one time. We think that there's a real case to be made to have bonds as part of your portfolio, as a permanent part of your portfolio, but of course dial up and dial down the allocation as you deem fit. Largely because it will be that sort of contrasting asset class to equities, right? Equities sell off, bonds might not sell off as much. And you can use that allocation to sort of sell it down and put it into equities once the drawdown happens and pick up on your equity upside. Yeah.
Thank you for that. I was expecting this question. With the recent high inflation rate and ever rising interest rates, how does inflation and interest rates affect the fixed income investments?
Yeah. So inflation and interest rates. So interest rates, when you think about interest rates, they tend to be at the shorter end of the curve. That's what the central banks determine. That's what the Fed determines, right? When the FOMC meets, they determine the 3-month rate or the overnight rate, right? And so you tend to see the rates as being very small. They don't necessarily move the whole curve up in parallel, right? So sometimes, and that's sort of the base case that we have here. It's going to be sort of a flattening sort of curve. You will see the front end of the curve move up because the Fed is hiking rates, because central banks are hiking rates. But because growth expectations tend to be lower, right? So the long end of the curve might stay more anchored. We've seen the long end of the curve drift upwards, like the US 10-year Treasury, I think, crossed 2% last week from a yield perspective. And that's largely pricing in whether it's inflationary expectations into the future or growth expectations into the future. But we don't think it's going to affect sort of across the curve as the whole curve moves up. Now, if you know your fixed income investments, when rates go up, price goes down. But because of the way the yield curve moves, right, it doesn't move in one smooth movement upward. It will have kinks. It will have sort of, how do you call it? Different parts of the curve moving differently at different magnitudes. That's sort of where the opportunity lies, and you can take advantage of that depending on where you're positioned. So if the view is that long duration and the long end of the curve is going to continue selling off and moving up, then you don't want to be positioned there. You want to sort of have a more like hedged approach to interest rate risk, be positioned at the front end of the curve or in variable rate securities.
What is your outlook for the bond market, and what are some of the industries that we should look at in the near future?
Yeah, so within the bond market, I think the opportunity is going to lie within the high yield space. That's where we're seeing opportunities at the moment. We are seeing low default rates. We're seeing good corporate fundamentals. You don't want to be allocated again to like high yield as a whole. So don't buy an index, not buy ETF, but like choose managers wisely, choose managers that have a good track record, choose managers that know how to select high yield bonds properly. Because when you buy an index, and fixed income indices are very different from equity indices. Fixed income indices reward the companies or countries that issue the most debt, right? Equity indices, on the other hand, they're market cap based, and they reward companies that grow. They reward your big companies, right? Companies that do well. It's almost the inverse in fixed income indices. They're not great measures of where value is. So don't necessarily allocate to a blanket beta type of instrument. You want to really have a manager that can go in, do good fundamental analysis, do the bottom-up work, and find the companies with strong fundamentals that you want to be allocated to. But to answer the question specifically, where we're seeing opportunities within the bond market really is in the high yield space and within the lower quality IG space. We think securitized structured assets, rather. So your mortgage-backed securities, your RMBS, these look interesting as well, given their variable rate feature, given that housing prices and real estate in the US is still like looking quite strong from an outlook perspective.
Okay. And Singapore question from one of the viewers: will the instability of the Hong Kong market cause some capital flow to Singapore markets?
That's very possible, right? I mean, we're already seeing it. We've got Hong Kongers coming here to, they've had enough of being locked down in Hong Kong.
Absolutely.
And they're moving here, they're driving up real estate prices, rents are going up. You're probably going to see that happen in the capital markets as well, as they bring cash over, whether they start investing, in the SGX or in the local Singaporean government bond market. So yeah, definitely, I think we're going to see capital flows into Singapore.
And someone would like to know, is it okay to hold on to China bond funds?
Regards to China is that the opportunity is early. We think that there's value in sort of sitting out on the opportunity in China at the moment, and maybe waiting out 9 to 12 months before allocating back to China. If you're talking about equity, maybe there's a case to be made there that we're somewhere near the bottom. But I would still hesitate on giving China a double thumbs up at the moment. Yeah.
Next question. How is the fund set up and where is the yield?
How is the fund set up and where is the yield? So the fund is very flexible. It's got a broad mandate. It can allocate to across all the asset classes within the fixed income universe. And the way that yield is, so the yield decisions really are made twofold, right? So one, we want to generate that level of yield that investors anticipate, that investors want, but we don't want that yield to be sort of too high, and you introduce like credit risk into the portfolio, right? Because that's not where we want to be. So to say another way, we want to have a sustainable level of yield for the portfolio, given the macro environment. And where we see ourselves in the macro environment now, we were a bit mid to late cycle. And then with this new Ukrainian war coming in, there's a lot of macro risks going 6 months, 9 months into the future. So yield, from a yield perspective, we're going to see it sort of drop a little as we bring more defense into the portfolio. We take a more risk-off stance, right? But where you're going to be rewarded really is from the total return perspective, right? So from capital appreciation, you're still going to see that sort of play out in the portfolio. And we've got analysis to this, but during times and periods when we under yield sort of like the broad high yield index, we tend to do better from a total return perspective because we always keep in mind the capital preservation side of bonds and how you can sort of like, it's easier to dig yourself out of a smaller hole than a larger ditch.
Yeah. Well, thank you so much, Johnathan, for answering
maybe if
all
I
our
can
questions. Yes, sure.
Hi, sorry. I think
Hi,
the question
Eugene.
is, hi. I think from a product level perspective, so Johnathan has mentioned about on the strategy level perspective and maintaining the yields. From a product registration perspective, the one that we have been mentioning earlier on, the Brandywine Global Income Optimizer Fund, and the one that's available on the Moomoo platform, on the fund level, it yields approximately 4.5% in terms of annualized dividend yield. So that pays out on a monthly basis. So that's a Sing dollar hedge share class that's available on the Moomoo platform. So it's an Irish domiciled vehicle, meaning that it's on a recognized scheme in Singapore. So it's available for retail sale.
Thank you for that. Anything else to add, gentlemen? And perhaps maybe some final thoughts for our audience watching.
I think the only thing I'll add is to just reiterate the point about fixed income as an asset class. It's really fallen out of favor. I feel like I'm an evangelist here trying to sell fixed income in an environment where equity is like sort of rallying. But I really think that as a personal investor myself, when I look at my portfolio right now and it's all in the red, the sort of one redeeming quality is going to be fixed income, right? And having that fixed income allocation, and talk about skin in the game, I am invested in my own fund as well. The fixed income allocation really is there to sort of, one, from a mental perspective, make yourself feel a little bit better about your portfolio, and two, allow you to have that capital that you can sell down that fixed income allocation when equity has drawn down, when there's really opportunities present in the equity markets. Sell it down, allocate it to equity markets, watch it rally, make money, allocate it back to fixed income for safety. So anyway, final thoughts.
Thank you so much, Eugene. Anything else to add?
No, I guess echoing what Johnathan has mentioned, fixed income is definitely an essential part of anybody's portfolio, unless you're daring enough to allocate 100% in equity markets, and then after that complain about the volatility. So I guess from a historical point of view, if you're a pure equity investor, every single year you do want to anticipate a certain standard deviation or volatility level of about 15% and above. in terms of standard deviation of your portfolio. But if you are in 100% into bonds, then that level of standard deviation decreases significantly. So on a normal basis, and we're not talking about today's times where there's stagflation, where there's the Ukrainian war, there's interest rates rising. But in normal times, investment grade bonds tend to have a volatility profile of about between 3 to 6%. High yield bonds will have a volatility profile of about 6 to 10%. So that's definitely much lesser than a pure equity portfolio. As what Johnathan has mentioned, if you have to essentially asset allocate certain portion of your whole investment portfolio in fixed income to mitigate the volatility that equities is going to give you. So, and if you asset allocate into fixed income, you look at high yield, you look at investment grade, as what Johnathan has mentioned earlier on. It is our preference right now. It is the sweet spot now is to buy into the lower grade investment grade and the higher quality high yield grade. So in the triple Bs and the double B spectrum, and you need to identify a fund manager that can actively identify the opportunities within this narrow spectrum itself, and that's where the capabilities of Brandywine Global come into play. They have the strategy, they have the product. It's available on the platform right now on the moomoomoneyplus platform. So it's something for your consideration if you wish to have some allocation into such a fixed income instrument. In the long run, this is definitely going to benefit your personal investments. This fund is in my personal investment portfolio, so it's doing very well for me. And as what Johnathan has mentioned, the drawdown, meaning how much the fund has fell, it's definitely relatively much lesser than other fixed income funds that I had in my portfolio. So some points for your consideration tonight is just all about fixed income. Do keep in mind that in a very volatile market where everybody's misbehaving and sometimes fundamentals just don't matter anymore. We are in a new world, a new era of investments. It does help to pay attention to who's capable of managing your monies in such a situation, and that's the Brandywine Global for you.
Thank you so much, Eugene. And thank you, Johnathan, for today's discussion. I'm sure the audience enjoyed it just as much as I did. Now, to everyone watching, if you really enjoyed a webinar like this, remember tomorrow we're coming back here in the same room at 7 p.m. for our last webinar, and Eugene will be the speaker.
Yep, it'll be my turn.
So we'll see you tomorrow. And if you want more updates as well, you can follow our socials and also our app activities, and also keep leaving your questions. We'll get to it afterwards. But thank you once again, gentlemen, and thank you to the viewer watching. We'll see you tomorrow at 7 p.m. Once again, I'm Olivia Higgins. Have a good evening. Bye.
Take care. Stay safe.